Welcome to All Things Finance. In this video, I will be talking about bond yields, elasticity, and duration. In investing in bonds, investors have to look into the different yields in order to determine if they are indeed gaining or losing. There are four kinds of yields to consider, namely yield to maturity or YTM, current yield or CY, yield to call, and total yield. Yield to maturity or YTM is the total return anticipated on a bond if the bond is held until maturity. YTM is considered a long-term bond yield but is expressed as an annual rate. In other words, it is the internal rate of return or IRR of an investment in a bond if the bond investor holds the bond until maturity, with all the payments made as scheduled and reinvested at the same time. YTM accounts for the present value of a bond's future coupon payments. Without a financial calculator, the best way to compute for the YTM is through a trial and error method using the bond price equation but YTM as the X. So here we have bond price equal to coupon times 1 minus 1 over 1 plus YTM raised to the power of n all over YTM plus the function face value times 1 over 1 plus YTM to the power of n. So here we have a sample problem. Suppose your 7% $1,000 par value is selling for $950 and matures in 4 years. So what is the yield to maturity? So I present to you 3 steps in solving this problem. First, we recognize the given. Second, we input the given on the formula as I gave earlier. Then, third, we solve using your calculator. So, what are the given of this problem? We have bond price, which is $950. We have coupon rate of 7% times 1,000 face value, that's $70. And we have periods of 4 since it is 4 years. Second, we input the givens on the formula. So that's bond price, we have $950 times equal to coupon, that's 70 times 1 minus 1 over 1 plus x. So x there is the yield to maturity raised to the power of 4 all over x plus the face value of 1,000 times 1 plus x, or the yield to maturity raised to the power of negative 4. So, we input everything in our calculator and we solve for x. So, x is equal to 8.5%. The second yield you must consider is the current yield. So, the current yield or CY is an investment's annual income divided by the current price of the security. This measure examines the current price of a bond rather than looking its face value. Current yield represents the return an investor would expect to earn if the owner purchased the bond and held it for a year. So the formula to get current yield is CY is equal to interest payments over bond's current price. So example, if we have 1,000 bond with a 7% coupon and we're currently selling at $950, same as this previous problem, what is the current yield? So here, CY is equal to interest payment over bond's current price. So, CY is equal to 70 over 950, and that is 7.37%. The third yield to consider is specific only to callable bonds. Yield to call, or YTC, refers to the return a bondholder receives if the bond is held until the call date, which occurs sometime before it reaches the maturity. YTC applies only to callable bonds, which are debt instruments that let bond investors redeem the bonds on what is called the call date at a price known as the call price. Calculating the YTC on callable bonds is important because it reveals the rate of return the investor will receive assuming the bond is called on the earliest possible date, the bond is purchased at the current market price, and the bond is held until the call date. The formula in calculating the YTC is the same with YTM, only that the period and the lump sum amount will differ. Instead of having the original maturity date as the period, you consider the call date as the period. Also, instead of the face value as the lump sum, you use the call price. Therefore, the formula is current price is equal to the coupon times 1 minus 1 over 1 plus YTC raised to the power of C, which is the call date, all over YTC, plus call price times 1 plus YTC raised to the power of negative C. So here, where C is equal to the years to call date times the frequency of payment in a year. So example, a 10% semi-annual coupon $1,000 bond is selling for $1,175 and has the option to be called at $1,100 5 years from now. Solve for YTC. So the formula, then we input all the given. So we have bond price of $1,175. Our coupon is 50 because it is annual, semi-annual. Then YTC all over 2 raised to the power of 10 because that's 5 times 2. So we get YTC is equal to 7.43%. And the last bond yield you have to consider is the total yield. Total yield is the total of the current yield and the capital gains yield. Capital gains yield can be computed as the percentage change of the prices. So total yield is equal to CY plus CGY. Total yield is then equal to the interest payments over bond's current price plus the capital gains yield, that is price sub 1 minus price sub 0 all over price 0. So example, you have a bond priced at with a carrying value of $95.75 and has an annual coupon of $5.10. If the bond is a 10-year bond with 9 years remaining and you are only planning to hold it for 1 year and the price of your bond fell to $87.34, what would be your net gain or loss for the period? So in computing for such, we use the total yield. So that is interest payments over bond's current price plus the capital gains yield formula. So we have interest payments of 5.1 over the bond price, 95.75, plus the current price at the end of the year, that's 87.34, less the price you bought the bond, that's 95.75, all over 95.75. So that's 5.33% plus negative 8.77%. So our total yield for this bond is negative 3.44%. Now let's go to bond elasticity and duration. The prices of bonds can vary, but not every bond is affected in the same way when circumstances change. If the typical market interest rate drops, market price will fall for all bonds, but not at the same rate. Bond price elasticity refers to the sensitivity of the price to the changes in interest rates. Elasticity is a statistical concept but is widespread in economics, and we will now take a look at in this context. We can determine the interest elasticity of the market price using the following. So elasticity is equal to the price sub 1 minus price sub 0 all over price sub 0 over rate sub 1 minus rate sub 0 all over rate sub 0. The numerator is the current price change in percentage and the denominator is the interest rate change in percentage. Example. The table shows the price sensitivity of a 10-year bond with a $1,000 par value and 4 different coupon rates: 0%, 5%, 10%, and 15%. Initially, the market rate is at 10%. The price of the bond is actually the present value of the future cash flows discounted at 10%. The initial price is shown in column 2. In column 3, the prices are reflected when the market rate is at 8%. On the fourth column shows the percentage change in bond price, which is the numerator in our formula. Then, on the fifth column is the percentage change in the rate, which is the denominator in our formula. On the sixth column shows the computed bond price elasticity. On a zero coupon bond, for each 1% change in interest rates, the zero coupon bond changed by 0.995% in the opposite direction. On a 5% coupon bond, for each 1% change in interest rates, the bond changed by 7.765% in the opposite direction. The table shows that the price elasticities of the higher coupon bonds are considerably lower than the price elasticity of the lower coupon bonds. On the second table, this shows the effects of an increase in the required rate of return from 10% to 12% and the bond price elasticity. Still, lower coupon bonds have higher elasticity than the higher coupon bonds. Next, let's go to duration. An alternative measure of a bond's price sensitivity is the bond's duration. Duration was first developed by Frederick Macaulay in 1938 and is used widely since 1952 when F.M. Reddington alerted financial corporations of its importance. This just shows how recent some concepts are in finance. Duration is officially the measure of the average cash-weighted term to maturity of a bond. Practically, it means how much an investor has to wait for his investment to break even on average. It has a large formula, but do not be swayed as it is not difficult. So this is the formula for duration. Here we have, it is the summation of the cash flows times the time all over 1 plus r raised to the power of t all over the summation of the cash flows over 1 plus r raised to the power of t, where c is the coupon or principal payment generated at the end, t is the time at which the payments are provided, and r is the bond's yield to maturity. The numerator is really the maturity of the cash flows weighted with the present value of the respective cash flows. The denominator is actually the current price of the bond or the present value of the cash flows. Example. The duration of a bond with a $1,000 par value and a 7% coupon rate, 3 years to maturity and 9% yield to maturity is calculated as duration is equal to 70, that's our coupon, times 1, that's our first time, over 1.09%, that's our yield to maturity raised to the power of 1, plus 70 times 2, that's the second year, over 1.09 raised to the power of 2, plus 1,070, that's principal payment plus coupon times 3 on the third year, over 1.09 raised to the power of 3, all over 70 over 1.09 raised to the power of 1 plus 70 over 1.09 raised to the power of 2 plus 1070 over 1.09 raised to the power of 3. So we got 2660.76 as our numerator and 949.37 as our denominator. So our duration is 2.8 years. So thank you so much for watching. If you enjoyed this video, please click subscribe, like, and share to anyone who are interested in bond yields, elasticity, and duration. Thank you so much and have a great day.